new shiny object, artificial intelligence, that is has the potential to improve the productivity of a lot of companies and a lot of industries and everything from pizza shops to running big industrial companies. This is sort of like the internet paradigm of the 1990s, but with real money. These companies are actually making real money, unlike the 90s. So I think that's what's moving it right now. The larger questions are, of course, whether or not the economy stays strong or not. But for the moment, there's a reason stocks are hitting new highs overall. So that's where we're at right now.
So, Bob, we had the Fed meeting. We've talked about inflation, AI, a lot of things moving the markets. How are stocks doing so far this month?
Well, we're at new highs. I mean, I think that we had 4 consecutive days of historic highs on the S&P 500. But remember, the S&P is market cap weighted, so the bigger stocks move things. And it's been primarily technology stocks moving things on these artificial intelligence story. If you look at the rest of the market, it's been a little bit weaker this month here. So disinflation is not always good for everything. So, for example, energy stocks, material stocks that have pricing power, commodities on higher inflation, they tend to get hit a little bit more. Consumer staples stock, remember, Hershey's and everybody kept raising prices on food. It's harder to do that when inflation's going down. You can't get away with it. People push back. There's already been pushback on fast food prices. McDonald's having to go to value menus because people are pushing back. That impacts margins. So disinflation isn't necessarily always great for everybody. You want inflation to come down from these levels. I think it's good overall. But when you have pricing power, you can get away with a lot of stuff. Industrials have been a little weak. I think there is some, after a huge run in the last couple of years, I think there are some slower growth concerns that are out there, but these industrial stocks have had big moves up. So the multiples, what they're trading for relative to the earnings, are higher than they were a couple of years ago. So it's not surprising to see what's going on here. Tech is powering things right now.
So let's zoom in on one company in particular that has had a lot of interest recently, and that's GameStop. What's happening with shares of GameStop recently?
Well, I have very multiple opinions about this. What was it, $11 6 weeks ago? Now, I guess I didn't look today, but it's probably $28 or $29. This all has to do with the influence of Keith Gill, known as Roaring Kitty. The financials metrics are terrible for this company. GameStop is essentially a video game collector store where people swap and buy video games on video discs, which are not on discs, which is not the way people do this anymore. So the business has been essentially, the video business on the gaming business on that level has been declining for years. It's a viable business, but it's certainly not worth anything like this here. So if you look at their earnings, they lost 11 or 12 cents. It's been declining. I think they have a market capitalization now of $9.7 billion. So what they have done is successfully raise money because the stock price has gone up. So they've had a $2 billion share sale. They had a previous round of offerings that raised almost $1 billion. So if you look at this company, what is it? I think I'm trying to remember. Wedbush, I believe, had a note out recently. There's only a couple of analysts covering it because everybody's thrown up their hands. And they had an $11 price target, and $9.50 of it, as I recall, was the cash they have on hand. The company itself, they thought, was worth $1.50. Okay, so that tells you what's going on here. You got a company with enormous cash hoard. Now, theoretically, you could turn around and say, I'm going to go into some other business. It would be a little crazy to announce that suddenly they're going to expand into, buying more or opening more GameStop stores. I would find that rather extraordinary. Maybe they'll transform themselves into something else. They'll use the money to buy something, become a crypto company or something. I don't know. But it's very clear that the value of this company is primarily in the shares prices, the money that they've raised for the new shares. It doesn't have any. The fundamental value of the company is very, very small. So people messaged me when this happened a few years ago and said, doesn't this indicate that fundamentals don't matter? I mean, look at the price, it's moving. There's no relationship to what the fundamentals of the company are. And my answer to that is, if stocks have always been valued on a future flow, a future cash flow, earnings or dividends, something that it throws off that it gives the dividends, gives to investors, give back to investors. And I don't think that has changed at all. You can get people to invest in stocks on other than fundamentals if you want to. There have been attempts over the years. We had a fellow in the 1990s, Arch Crawford, who we used to have on the air, who made stock predictions based on astrology. You know, the moon is in Venus by Microsoft. I kid you not. And we used to laugh at this 30 years ago, but he had a following. People wanted to follow him. If you can convince people that you should buy stocks based on sunspots and get enough people to do that, you could move the stock. But don't kid yourself. From the dawn of time, for 400 years, the purpose of a stock is to allow the investors to participate in a future stream of profits. That is literally the definition of a stock. So I don't see a future stream of profits here. I see the potential for them to transform themselves into something else maybe. And that's the primary value of the company. But don't kid yourself. It doesn't mean suddenly that fundamentals don't matter.
So, Bob, there have been some companies announcing stock splits recently. What does a stock split mean for investors?
Well, you know, it's very interesting. Walmart announced one in January. I was quite shocked because stock splits have gone away. They were a very big deal in the 1990s during the dot-com bubble because, I mean, it just happened all the time because the stock prices went way up. After the dot-com bust, and particularly by 2002, stock splits went away. And they disappeared during the financial crisis, and they never really came back. Even when the market got better after 2010, they never came back. And they didn't come back because what's happened is institutional investors dominate the stock market, not retail investors. And those people are they don't care if the stock's $100 or $200. They want to go buy 10 million shares of Pfizer. They have to buy 10 million shares of Pfizer. Whether it's $100 a share or 200, they don't care. They're buying 10 million shares of Pfizer. So it's not that they're price insensitive, it's just they're buying by the dollar amounts. Retail investors may have a problem with a stock that's $1,000, you know, like a Broadcom or something like that. And what I see here is there's this flurry of announcement recently. Williams-Sonoma announced one, Broadcom, NVIDIA, Chipotle, a bunch of other ones, Lam Research. And it seems to me like they're getting a little more sensitive to the idea of attracting retail investors, which are a very small part of the market, but could be important. So I think there's a subtle shift here going on. So what do you get here? The question is, does splitting your stock 2 for 1, 3 for 1, 5 for 1, whatever, does that have any influence? And the short answer is no, because it doesn't change the value of the company. However, it's a little more subtle than that. So think about what happens when you do a stock split. First, your trading volume goes up. That may help the stock. Liquidity improves. What's liquidity? Liquidity is the ability to trade a share without moving the stock price. And usually when you split the stock, the liquidity improves. Third is that you get usually an increased shareholder base. And in fact, NVIDIA, Walmart, Williams-Sonoma, they all said that. They were interested in broadening out the shareholder base. So the short answer is theoretically splitting a stock doesn't mean anything, but there may be subtle effects that are beneficial for doing that. And the question here is, to what extent is corporate America going to notice this and other people are going to jump on the bandwagon? So are there any other companies out there? There's very few $1,000 companies out there. I call them the $1,000 holdouts. So Bookings Holdings, 1,000, somewhere around there. AutoZone is close to 1,000. Decker's Outdoors. Those are, if this trend continues, those are interesting candidates potentially. There's other high price stocks out there. Costco is I'm talking about retail focused companies. Supermicro Computer, they joined the S&P recently. That's a pretty high price stock. And if corporate America comes to believe that there's a real trend here that they can attract attention by splitting their stocks, retail-facing companies that are lower priced may consider this. I don't know. Spotify is $300, somewhere around there. Ulta Beauty is 400. ServiceNow, not really a retail stock, but that's a stock retail people play around with. That's a $700 stock. So there's a lot of potential people that are out there, or companies that are out there that could split their stock. This week was a little flurry of announcements.
Yeah, well, we'll definitely watch and see if any of those other companies make announcements. So next up, Bob, let's talk about IPOs. Where does the IPO market stand? What are you watching there?
Well, we have one today, and I don't think it's Tempest AI. Sorry, I'm checking my computer here. It was not trading a few minutes ago. Supposed to open today on the NASDAQ. This is an interesting company to me because it's an AI-focused company. So what they do is they do medical diagnostics using AI. So you have an oncology report or a radiology report, and they use AI to read it and assist your doctor in potential healthcare. And I think Tempest opened, so it priced at $37, and it opened at 40, and it's currently trading at 42. Okay, so that's a pretty good number. So this is one of the only ones that are out there. Astera Labs opened earlier in the year. That's an AI-focused company. So this is potential to really help the IPO market out. I think the problem is if you're an AI company, you likely can get a lot of money to stay private. And most companies, when they're young, would like to stay private just because it's just easier to manage. When you're a public company, you have quarterly expectations. It's just harder to manage. So part of the problem is these companies can get a lot of money already, raise money in the private funding business, and stay private longer. So I think that's going to be a problem. The IPO market is doing okay this year, better than last year, which was better than 2022, but it's been a disastrous few years. I mean, basically, the IPO market collapsed. So there's a lot of companies backed up in a long queue. And I think, I'd like to see more of them open. In theory, we have a good market. The S&P is at a new high. Interest rates are coming down. I mean, this is all good news, essentially. But there's a lot of companies that raised money at very high valuations in 2021 and 2022. And there's pressure on them when they go to market. If you're valued at, say, $10 billion, can you go to market at $6 billion? Because there's going to be too much pushback if you try to value it at $10 billion. It's called a valuation haircut. And a lot of companies are facing this. I think Tempest faced this itself. So that's a problem for a lot of companies. They don't want to take the valuation haircut. So you stay private as long as you possibly can. We'll see. I have been disappointed for years in the pace of IPOs. People complain there's too much regulation. It's too hard to deal with investor expectations. It's easier to stay private, maybe, but this deprives a lot of investors of early gains. In the 1990s, we had the dot-com thing. We had stupid stuff like pets.com. And people said, well, this stuff didn't make a lot of money and it was very volatile. But these companies went public much earlier. They were younger, so they were more volatile. And I'd rather see that, frankly, and allow the public to have access to that, as volatile as it is, than waiting for some company that's already in middle age, like Instacart that went public, been around a long time. By the time those companies go public, any benefits from the growth, the early growth, is gone, essentially. You're a mature company. So you don't get those benefits. So I'm in the camp that wants to see more companies public. And make it easier for companies to go public, not harder.
All right, and Bob, before we go, I know a lot of our audience is probably gearing up for their own summer travels, but I'd love if you could share more about your recent trip to Italy.
Well, my mother had a very significant birthday, and she wanted to go to Italy. It's one of my favorite places in the world. I've been there more than a dozen times, and it's very hard to have a miss on Italy. From the wonderful people to the wonderful scenery, the wonderful history, and most importantly, the incredible food. You really have to go out of your way to get a bad meal in Italy. Really, you have to go out of your way. So my mother wanted to see The Last Supper. and in Milan by Da Vinci. And the time to go to Italy, if you're a seasoned traveler, is generally May and September and October. July and August, it's overrun by tourists, overrun by people with their kids who are out of school. And so professional seasoned travelers don't go to Italy in July and August. The Italians themselves don't go to Italy. The Italians leave and go to southern Italy or France. They don't even do it. There's a lot of people not working in Italy, you know. So what happens is May is a good time to go. So we went, you know, towards the end of May, and it turns out it was overrun. Milan was just packed with tourists, and they are expecting something like 60 million visitors this year, all-time records. People are traveling like crazy still. Now, this is good news for Italy because it needs the money. Okay, so great. Unfortunately, it puts a lot of pressure on the infrastructure, and it puts a lot of pressure on the monuments. They are essentially restricting access to the Last Supper now. You have to buy tickets weeks in advance. It really was difficult to get tickets. And they are restricting it to 30 people at a time. This is a pretty big room. It's next to a church. And they don't want people coming in because so many people coming in, breathing on the painting, even though it's a little high up, degrades the painting. This thing is, you know, 1600. We're dealing with almost 500 years old. And this is a problem all around with the classical monuments. Venice is essentially they're restricting access to Venice. They're charging €5 to get into Venice if you're coming in off the shore. It turns out most people who go to Venice, they don't actually stay there. They stay in cheap places on the coastline, on the mainland. And they come in, they have a glass of wine and walk around. So they're charging €5 to get in and hope to sort of deter people. I don't know if that'll work or not, but it's a wonderful, wonderful place to go. But what are the consequences of all of this? You know, tourism, and you see it. You know, they have to find some way to manage this flow, or the country's going to just be overrun, and the monuments will be damaged essentially. So I wouldn't let that deter you from going to Italy. One of our favorite things to do now is cooking classes. We've gone to cooking classes in Bologna and made bolognese sauces and made tagliatelle. We've gone to cooking classes in Milan and made tiramisu and cavatelli. And let me tell you, when you're in somebody's home in Milan and you're making your own pasta, I mean, literally, you know, flour, water, or flour, eggs, and water, and you're rolling your own pasta by hand, and then you're eating it or making the sauce, the bolognese sauce, it's really quite an experience. It's much, much different than opening, you know, Chef Boyardee. And you're sitting there with a nice glass of wine with the host. It's a wonderful experience. So I wouldn't let worries about crowds. If you can go in the off season, that's the time to go, particularly in the South, like Naples or the Amalfi Coast or Puglia, Bari. Those places are unbearably hot in July and August. The middle of September into the middle of October, they're perfectly fine. They're in the 70s and even in the 80s, depending on what time you go in September. So that's what I would do. Go to Italy. Yeah. Go to Europe. Travel in general. It's my favorite endeavor. I've spent my life traveling. My wife and I have been in over 60 countries together, and we plan to keep traveling.
Yeah, well, I think that's great advice for people. And it's kind of crazy, you know, it's so busy now. I can't even imagine what it's going to be like later this summer in July and August. It'll be
There's a Trader Talk, if you want to learn more about it, I wrote. You can go to tradertalk.cnbc.com. I wrote a story about my experience traveling in Italy this time. tradertalk.cnbc.com, you can see it up there.
Yeah, we'll definitely go check that out. Thanks, Bob, for answering all of our questions. Thank you to everyone who sent in your questions, as always, and we'll talk again in a couple weeks.
Thanks.